Welcome to StockTok's deep dive into PACCAR Inc. PACCAR is one of the world's premier manufacturers of heavy-duty commercial trucks, operating the Kenworth, Peterbilt, and DAF brands across global markets. At the time of recording, shares are trading at $126.25, sitting near the upper half of their 52-week range of $84.65 to $131.88. The 50-day moving average stands at $121.51, and the 200-day at $106.98, meaning the stock is trading above both key trend lines. The RSI, or Relative Strength Index, a momentum indicator on a scale of 0 to 100, reads 62.5, a neutral to mildly firm reading. Let's work through the fundamentals, scene by scene, starting with a quick business overview. PACCAR designs and manufactures premium Class 8 heavy-duty trucks, alongside a financial services division that funds dealer and customer purchases, and an aftermarket parts business that generates high-margin recurring revenue. The company's moat rests on brand loyalty among professional drivers and fleet operators, a vast dealer network, and decades of engineering reputation. The StockTok score for PACCAR comes in at 31 out of 100, signaling caution. Valuation scores 3 out of 20, financial health 13 out of 20, profitability 8 out of 20, growth 5 out of 20, and smart money just 2 out of 20. The overall GF score, a composite fundamental quality rating, sits at 83 out of 100, suggesting the underlying business is operationally sound, even as the composite investment score raises flags. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, PACCAR carries a trailing price-to-earnings ratio of 28 times, meaning investors are paying $28 for every $1 of reported earnings. That is a premium for a cyclical industrial manufacturer. The forward price-to-earnings ratio, based on expected future profits, narrows to 22.07 times, implying the street does expect earnings improvement ahead. The PEG ratio, which adjusts the price-to-earnings multiple for growth and reads 2.14, suggests the valuation is not supported by growth at current prices. Anything above 2 is a signal that growth is being priced in rather aggressively. The EV to EBITDA multiple, a capital structure neutral valuation measure, stands at 19.14 times, which is elevated relative to where heavy machinery peers have historically traded. The Guru Focus Value, an independent intrinsic value estimate, stands at $83.57 at the time of recording, against a market price of $126.28, implying a negative margin of safety of 51%, meaning the stock trades at a significant premium to estimated fair value. Wall Street analysts at the time of recording have a consensus mean target of $128 across 17 analysts, with a high of 150 and a low of 109. A broadly constructive but not enthusiastic setup. The next earnings report is due in late April of next year, with the street expecting earnings per share of approximately $1.14, ranging from $1.09 to $1.21, a near-term catalyst worth monitoring. In terms of competitive moat, in our view, PACCAR benefits from strong brand intangibles, switching costs in fleet management relationships, and a sticky aftermarket parts business. But these advantages are largely priced in at current levels. Market sentiment around PACCAR, as of the creation of this video, leans neutral, with insufficient recent news flow to move the needle in either direction. On balance, the valuation setup warrants caution, in our opinion. Moving to financial strength, how solid is the foundation? PACCAR Piotrowski F-score, a 9-point checklist measuring profitability signals, leverage trends, and operating efficiency, comes in at 5 out of 9. That is a middle-of-the-road reading. The business is not deteriorating, but it is not accelerating on all fronts either. The Altman Z-score, a model that estimates bankruptcy risk, where scores above 3 are considered safe, reads 3.70, placing PACCAR comfortably in the safe zone. On the debt side, the cash-to-debt ratio of 0.61 means the company holds 61 cents of cash for every dollar of debt, a moderate but not uncomfortable position for a business with a large financial services arm, which by its nature carries leverage. Interest coverage of 9.09 times means the company earns over $9 of operating income for every $1 of interest expense, a robust buffer. The current ratio, current assets divided by current liabilities, stands at 3.08, well above the 1.0 threshold that signals short-term solvency. Debt to equity of 0.81 is meaningful but not alarming in context. The overall balance sheet picture, in our view, is solid for an industrial with an embedded lending business. Not pristine, but structurally sound. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, the return a company generates on all capital invested in the business, which stands at 8.08%. For context, the general benchmark used by many institutional investors is that a business creating true economic value should earn its return on invested capital above its cost of capital, which for a mid-cycle industrial typically runs in the 8 to 10% range. PACCAR sits at the lower end of that threshold, suggesting the business is generating marginal economic returns rather than meaningfully compounding shareholder value at current capital levels. Gross margin, revenue minus the direct cost of building trucks, is 16.66%. That is characteristic of a capital-intensive manufacturer, where raw materials and labor compress headline margins. Operating margin after overhead and selling expenses comes in at 10.41%, a respectable number for the sector. Net margin, the bottom line percentage of revenue retained as profit, is 8.35%. And the free cash flow margin, free cash flow as a share of revenue, which tells us how much real cash the business generates after capital expenditures, is 10.65%. That free cash flow margin is notably stronger than net margin, which in our view reflects genuine cash conversion efficiency and supports the dividend program. On to growth. Is this business expanding, and at what rate? The revenue picture here is the most telling piece of the puzzle. Over the trailing 3 years, PACCAR revenue growth is essentially flat, negative 0.4% on an annualized basis. That is not a disaster, but it is a meaningful deceleration signal for a company trading at a premium valuation multiple. Zooming out to the trailing 5-year picture, revenue has grown at 9.8% annualized, demonstrating that the business does have cyclical upswings embedded in its history. But the recent 3-year plateau suggests the company may be working through the back half of a trucking cycle, where order books soften and fleet replacement slow. Book value per share, a measure of the net assets attributable to shareholders and a proxy for long-term compounding, has grown at 13.3% over the trailing 3 years, which is a genuinely strong number and suggests management has been effective at retaining and deploying capital during the cycle. The dividend yield at the time of recording is 1.05%, modest in absolute terms, but PACCAR is well known for supplementing its regular dividend with special dividends in strong earnings years, making the headline yield somewhat understated as a total income picture. The growth score of 5 out of 20 reflects the near-term revenue stall and the cyclical headwinds the data suggests the company is navigating. Now let's talk smart money. What institutional capital is actually doing with this name? 8 top-tier guru investors and super investors currently hold positions in PACCAR, according to the data available at the time of recording. The most notable disclosed holder is the Bill and Melinda Gates Foundation Trust, which carries a position representing 0.31% of its portfolio with no change in recent filings. A passive, steady hold rather than a conviction build. When we look at the broader 13F filing universe, the mandatory quarterly disclosures that institutional managers with over $100 million in assets must file with regulators, only 6.3% of filers are net buyers of PACCAR. The institutional benchmark we use as a signal of broad conviction is 50% or above for net buyers to indicate genuine momentum from the smart money community. At 6.3%, the data suggests institutional appetite is decidedly muted. Insider ownership stands at 3.84%, a moderate level that implies management has some skin in the game, but not an unusually concentrated founder-level stake. Most concerning to us is the insider transaction data over the trailing 3 months. There have been 0 insider purchases and 10 insider sales. Insider selling in isolation is not always alarming. Executives sell for personal liquidity reasons regularly. But a pattern of 10 sells and 0 buys with no visible accumulation is a signal that warrants attention, in our opinion. The smart money score of 2 out of 20 reflects this overall picture: limited institutional conviction and one-directional insider activity. And finally, the verdict. Let's bring it all together. On valuation, the data suggests PACCAR is trading at a meaningful premium to its estimated intrinsic value, with a trailing price-to-earnings of 28 times and a negative margin of safety of 51%. In our view, the setup is stretched for a cyclical industrial. On financial strength, the balance sheet is sound. An Altman Z-score of 3.70, interest coverage above 9 times, and a current ratio over 3. The foundation is not at risk, in our assessment. On profitability, margins are characteristic of the sector and free cash flow conversion is genuine, though return on invested capital of 8.08% sits at the lower boundary of value-creating territory. On growth, the near-term revenue deceleration over the trailing 3 years is a yellow flag, even as the 5-year picture is more constructive. The company appears to be in the softer part of the heavy truck cycle, based on what we see. On smart money, the combination of minimal institutional buying, 10 insider sells against 0 insider buys, and a smart money score of 2 out of 20 warrants real caution, in our opinion. Taken together, while PACCAR is a well-run business with an admirable track record, the current price appears to already reflect a great deal of optimism. We would want to see either a meaningful price correction or a resumption of revenue growth before the risk-adjusted setup becomes more compelling. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on PACCAR Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.